everyone, Jeff Rivett, Portfolio Manager at Creed Capital Management. Hope everybody had a nice summer and is getting back into the routines of fall. Overall in the markets, the summer was positive. July was a very good month. And August started off as a good month for the first half. Our balanced portfolios were up about 2% mid-month. And then we saw a decline at the end of the month, and we ended up a bit negative. But overall, the TSX in Canada was up about 5% for July and August. U.S. markets were up about 8%, and even bond markets were up about 2%. So it was a positive summer, but we've still got a ways to go, and what's been continues to be a challenging year. Obviously we've had inflation issues. We've had the Ukraine war, interest rates rising. We've had supply chain disruptions, making it hard to get things. We've had COVID shutdowns in Asia, and then most recently we've had fears of a recession. The good news is that with regards to inflation and supply chain issues, there seems to be a light at the end of the tunnel. In fact, looking at inflation numbers going forward now, it does seem that inflation peaked in June at around 8.6% or so, and the expectation now is that by the end of next year we could see that number fall down to around 3.5%. So that's good news, and we're already seeing that, especially in the prices when we look at more volatile components like food and energy. On the supply chain side, looking at goods moving around globally, when we look at the supply chain pressure index, which is a economic index made up to basically assess these things. We can see that levels have certainly come off, that things are moving around again, and that it's easier to get stuff. So we went through our perfect storm last year of inflation, where everyone had a lot of extra money left over after COVID, with nowhere to spend it, and you couldn't get stuff. Well, it seems like the ability to actually be able to obtain things globally is improving. So that's also been a positive. Biggest sort of challenge has been interest rates. And even though inflation seems to have peaked, it appears that we're not out of the woods yet as far as interest rate increases go. And that's largely because things are still pretty strong in the economy. Employment probably being the greatest strength. It's really hard to find good people right now, as anyone who does any hiring knows. There's 2 job openings per 1 unemployed person. So there's lots of demand still for people, but just no one to fill those roles. And when you look at wage growth, people are on average, wage growth has been about 7% this past year, which is certainly the most it's been in decades, and that's still expected to increase. So again, you're going to have people with more money, which is a good thing. But from an inflation perspective, there's still some concern by central banks, and that's why they've been talking about continuing to raise rates. And that was sort of the big change in August. Sort of in July, once we sort of saw that inflation had peaked in June, the hope was that that would be a smooth decline, and that interest rates would stop going up. And instead, we learned right around mid-August that in fact, no, the Federal Reserve wanted to keep raising rates, wanted to be really sure that inflation's in check. And so that does lead to concerns about a recession. When we look at several recession indicators, whether it's short-term interest rates compared to sort of the neutral rate in the economy, or where the Federal Reserve would like to have them, or when we look at the yield curve, which is essentially looking at 2-year interest rates, 5-year interest rates, 10-year, 20-year, 30-year, etc. We're in a period where the shorter-term rates are higher than the longer term rates, and that's what's known as an inverted yield curve. And pretty much every time that's happened over the last 60 years, we've had a recession, and I mean it naturally, I guess it makes sense because central banks are raising those short term rates to slow the economy, and so it's looking more and more like that's likely to happen. I guess the other thing to keep in mind is that if we do see a slowdown in interest rate rises, which potentially we think certainly rates will probably go up again this month. In the U.S., there's a meeting coming up this week or next week with regards to increasing rates, and there's a 90% probability that they'll raise rates by 75 basis points in the U.S., bringing them up to 3.25% in line with what Canada did last week. And then there'll be another meeting in December for both the U.S. and Canada, and the expectation is that they'll raise them another 0.75% up to 4%. So that's sort of what the market's expecting. And if that does happen, we'd expect to see, potentially sort of further volatility in the market, and certainly more likelihood that we could see a recession. Now, on the positive note, as far as household wealth goes, both Canada and the U.S. are really the wealthiest that they've ever been when measuring people's overall net worth compared to their disposable income, and debt levels are also pretty good, especially in the U.S. In Canada, we tend to be we have bigger mortgages, so debt tends to be a bit higher as a percentage of household. But in the U.S., debt levels are actually in the lowest 5 percentile of history for how low debt is compared to income. And again, this is at a time when employment is super high as well. So actual at the household level, things look pretty positive. And I guess on the other side too is, it's all well and good to say, okay, we're going to have a recession, but what does that actually mean for stocks? What does that actually mean for portfolios? And I think that a lot of the fear that comes out, certainly that we're seeing, is because we've had 3 recessions really in the last 20 years. We had the COVID recession, which was severe but very short. We had the 2008 financial crisis, which was probably the worst recession. It was the Great Recession. It was the worst recession we ever had. And we had the 2001 dot-com sort of blow up that led to a recession. So especially when you look at the 2008 recession, we had almost a year and a half long. So again, much longer than average. Most recessions are only about 10 months. So we had a year and a half long recession. We saw the stock market fall almost 40% during that recessionary period. And so, things were really, really bad. But that was a financial crisis, and that's different than when we look at recessions on average. In fact, when we look at recessions over the last 70 years, where we've had about a dozen of them, what we see is that the market actually during a recession is usually quite flat. So during that recessionary period, it may move around, but during that period, generally it ends up pretty much where it began. So quite flat. Where we see the worst performance is actually in the 6 months and 12 months leading up to the recession. And so similarly to what we saw this year, that's sort of a similar pattern where we've had a pretty difficult year, and we've seen this period leading up to the recession actually being the worst. And of course, after the recession is when all the money's made. And notwithstanding the Great Depression or what we saw in 2008. Pretty much every recession that we've been through, both 6 months, 12 months, and certainly 2 years out, has seen tremendous gains. Even looking at I guess the last recession, the short COVID recession we had, the recession itself was quite short. The impact to the market before that recession, again, was that short, sharp fall we had in early 2020 when the stock market fell about 35%. But what we saw in the year following that crash in 2020 and that 35% decline was almost a 78% increase back in stocks. So not only did we recover all that was lost, but of course we had a very positive 12 months after that drop. We saw something similar happen in 2018 during what then was the China trade tariffs and sort of bringing the trade restrictions on China. We saw almost a 20% market collapse then, and again that was followed by a 37% increase over the next 12 months. And certainly, I guess before that, the 2008 crash, where we saw a nearly 60% drop in stock prices at their worst, we saw an equivalent 70% increase over the next 12 months. So it seems like where we are now, I think that we've been through this period of anticipation where things we've had all this bad news this year, but it does seem that there's these spits and starts in the market of optimism. Certainly, we saw that at the beginning of August on the hope of interest rates cooling off. And again, even though we expect rates are going to go up in the short term, we expect interest rates again to rise again this month, and we expect them to rise in December. The longer term interest rates aren't moving up, meaning that the market expectation is that this is a short term thing and the rates are ultimately going to find their way back down. And that seems to be catching on as a trend again here early on this month, where when we look at the market performance in the first 12 days in our balanced portfolio, we're already seeing positive up to positive 1%. So hopefully that'll hold. Hopefully we'll continue through September, October, get to Christmas and get through that positive period that we usually see near the end of the year. Until then, if anyone has any questions on anything, certainly please feel free to reach out to me. Always happy to schedule a meeting as well to discuss your portfolio in person. Other than that, take care and talk again next month. Bye-bye.